Stick with metals here, but we're going to focus on copper and gold. Gold has had a pretty miserable year. No wonder. The US dollar has been going up and interest rates have been climbing. Our guest says there's a good chance that gold could head even lower. We are joined now by Bart Melek, Global Head of Commodity Strategy at TD Securities, right here in the studio. It's great to have you here.
Oh, it's fantastic to be here, Andy.
You don't see much of a case for a rebound in gold?
Not quite yet. I think the issue continues to be a Federal Reserve that's quite aggressive on the tightening front. Certainly this week on Wednesday, we're going to be probably seeing a 75 basis point increase in the Fed funds rate. TD Securities thinks that we're going to see the Fed terminal rate 500 basis points. And that ultimately means that as time goes on, there's going to be quite a sharp increase, a continued increase, rather, in nominal rates. But at the same time, as these inflation numbers, especially short-dated numbers, come down, a pretty rapid increase in real rates. And typically, as real rates climb, gold doesn't tend to do well. And as you mentioned, the US dollar is king dollar. And yes, gold is performing very well in other currencies, but the fact of the matter is you could probably do better buying the dollar on its own. So for now, we continue to see an exit from gold. Last week's CFTC data showed us that we've had a rally, but of course that was really short covering. We're not really noticing any significant increase in long positioning here. So we're doubtful that there's a lot of appetite to the upside for now.
Wow, so the Fed funds rate is 3.25% right now, and you see it going right up to 5%?
Yeah, that's our view. The Fed's dots are looking at 4.6, so we might have been one of the first ones that went to 5, but my understanding is others have followed suit, and I think that consensus will build. But the important thing here is the opportunity cost of holding gold is getting higher, and the carry is getting expensive.
Yeah.
And so it's difficult to hold on to a lot of this inventory. And even central banks now will likely lend that metal out, put it on deposit and get a very good yield that we haven't seen for 20, 30 years. And that's something to consider.
That's interesting. So they can lend out gold and the people have to pay interest on the gold borrowing.
That's right. So, and we haven't seen that environment for quite a long time. And generally speaking, gold is considered a zero yielding asset. But certain large players like financial, large official institutions, central banks, who have a lot of it, can actually put it in deposit and get a yield for the first time in a very long time.
I seem to remember that years ago, Barrick made a lot of money doing that.
It hasn't happened for quite a long time, and that environment is there. And, our other thing that is worrying us is that family offices and some prop traders still have long positions on, and as these carry costs get expensive, we might see that one more push to our target price of 1580. In fact, for the record, I'm just stating we are short gold in our model portfolio, and we're looking at 1580 for now. After that, I think I like gold. I like it quite a lot, but I think first things get worse before they get considerably better.
Why is it an asset class that people should own? Or do you reckon people should always consider having some gold?
I think it's a very good asset class as a diversifier in a well-diversified portfolio. Why? It quite often travels in the different direction than risk assets or equities. Over the very long run, gold goes up as equities tend to turn lower. And look, as bad as we think gold has performed this year relative to many other risk assets and fixed income on the long end of duration, gold actually has done pretty well. So in relative terms, it has performed pretty well. And over the very, very long run, we can say that gold is no one's liability. Once you have a bar of gold, you have a bar of gold. I'm not so sure that if I have a sovereign bond from some risky nations, that's going to pay out in 30 years or so. But I'm pretty confident gold. And, I'd just like to say that also over the longer period, notwithstanding these ups and downs we see because of interest rates and investment flows, gold very much follows the 90th percentile of the cost curve. In essence, it reflects true labor costs, it reflects energy and other cost inputs. And that means that over the long run, it will follow the cost of production, and therefore, almost by definition, it's a long-term preserver of wealth, and it mitigates inflation impact.
That's interesting when production costs have been going up pretty steadily. Just copper very quickly, Bart. What are your thoughts there? Is there upside for copper?
I think so, but we're still short right now. Again, that's another metal. And the Federal Reserve story is one reason. The other one is China is significantly underperforming economically. Some of their key manufacturing indicators are below 50. Some of the diffusion indices, like the Kiaxin, the real estate market is down, I believe, 25%. Prices are dropping, and let's face it, COVID is still a big problem. Last I've heard, there's another sequestering of the population because of COVID, some 1.3 million people, I believe, is Beijing this time. That doesn't seem to be going away, and China consumes over half. If China isn't aggressively buying copper to expand infrastructure and manufacture, well, that means demand is going to be depressed. We're probably going to see some destocking and downward price pressures as the West slows down and interest rates increase.
Bart, thank you.